The term finance is broad. However, it is distinct from accounting. The goal of accounting is to organize and compile past information, whereas finance prepares one to decide what to do with that information. Saylor.org end. In other words, accounting focuses on the past, and finance focuses on the future, which is why the concept of time is important in the area of finance. Unit 2, Module 1, An Introduction to Finance provides an overview of foundational finance principles. In this module, you will learn about different subspecialties and structures in finance. You will identify those underlying principles as well as determine the functions of finance in various management roles and business scenarios. In Module 2, you will distinguish between the different forms of business organizations and learn more about the issues related to achieving financial goals of a firm. You will address the financial market environment in Module 3 through exposure of the financial system, financial institutions, and markets, and will be able to explain how finance can affect the economy. Define finance and subspecialties in finance. Finance is the study of fund management and asset allocation over time. Key points. The three main areas of finance are financial institutions, financial markets, and financial management. The two main drivers of finance are the time value of money and risk. Since the value of assets changes over time, finance seeks to ensure the change is beneficial for the organization or individual. Financial professionals generally operate in an environment of uncertainty where they must make forecasts about future events. Key terms: investment, a placement of capital in expectation of deriving income or profit from its use. Asset, something or someone of any value, any portion of one's property or effects so considered. Debtor, a person or firm that owes money, one in debt, or one who owes a debt. Overview. Finance is the study of fund management and asset allocation over time. Funds consist of money and other assets. There are many different types of finance, but all are fundamentally concerned with studying how best to allocate assets in different conditions over time. Importance of time. The underlying driver behind all of finance is time. There are two reasons why time is so important to finance. Time value of money. For a number of reasons, money today is worth more than the same amount of money in the future. For example, you would rather have $100 today and $100 in 10 years. The money is worth more to you now than it would be in the distant future. We will explore this concept in greater depth later on. Risk. Making an investment does not guarantee a return. When a bank makes a loan, they're not sure the debtor will pay it back. There is a risk that the person will just take the money and run, or the debtor will file for bankruptcy. There are dozens of possible reasons the bank may not recoup the money they lent. The field of finance, however, embraces time. Finance says, since I know assets change value over time, how do I use that to cause my assets to change value in the direction I want? How do I manage assets so that they're worth more in the future than they are today? Challenges in finance. Figuring out what to do with assets is easy if all variables are known, and there is clearly one option that is better than all the others. However, most of the time this is not the case. Finance generally operates with a lot of uncertainty. As a result, companies hire entire departments of people to help them figure out which option is best. The role of finance and how it applies to various management positions in the scenario. Finance, economics, and accounting are business subjects with many similarities and differences. Each is a distinct field of study. Key points. Finance is the study of how to optimally allocate assets. Finance is fundamentally a forward-looking field concerned with what an asset will be worth in the future. Economics is the social science that analyzes the production, distribution, and consumption of goods and services. Accounting is the process of communicating financial information about a business. Accounting is fundamentally a backward-looking field. Key terms: return, gain or loss from an investment. Overview. Finance, economics, and accounting are business subjects with many similarities and differences. While they influence each other, each is a distinct field of study. Finance. Finance is the study of how to optimally allocate assets, how individuals and organizations should invest assets in order to get the highest possible return given changing conditions over time. Finance is fundamentally a forward looking field concerned with what an asset will be worth in the future. Economics. Economics is a social science that analyzes the production, distribution, and consumption of goods and services. It focuses on how economic agents, people, businesses, and government interact and make decisions. Economics is fundamentally the study of cause and effect. It tries to figure out how one variable affects economic agents or the economy as a whole. Accounting. Accounting focuses on communicating a business's financial information. Accounting is fundamentally a backward looking field, concerned with what has already happened financially and how that affects the company in the present. If accounting is the language of business, the financial statements prepared by accountants are the words. Statements are created under a standardized set of accounting laws, which makes it easy to compare and contrast companies. This indicates the financial health of a company. Overlap. Finance, economics, and accounting overlap in many areas. For example, an investor will use accounting to see whether a company has shown past financial success and to predict what the company will look like in the future. Part of that prediction incorporates economics. The investor wants to know what the overall economy will look like in the future and wants to know how the company will interact with its competitors. Investors can use finance to figure out what their investments will be worth in the future. There are few strong delineators between finance, economics, and accounting. All three fields intermingle and influence one another. It is almost impossible to have a strong grasp of one without at least a basic understanding of the other two. Finance is relevant to all business functions, the macroeconomy, and personal finances. Key points. Finance plays an involved role in the health of the overall economy. This impacts everyone, regardless of whether they have studied finance. Like companies, individuals are faced with investment and financing decisions. Having a firm grasp of finance will help individuals make those decisions. All business functions deal with finance because they need to be able to make the financial argument for the funding of their projects and to manage their budgets. Key terms. Leverage. The use of borrowed funds with a contractually determined return to increase the ability of a business to invest and earn an expected higher return, usually at high risk. Finance. The study of finance often seems narrower than it really is. There is a lot of talk of issuing bonds or pricing projects, which belies how relevant finance is to everyday life, regardless of whether you have any desire to work in finance. Understanding the economic environment. Finance plays an involved role in the health of the overall economy, which impacts everyone. The field of finance explains why the 2008 recession occurred. It is the reason people care about how the stock market is doing each day, and it articulates why businesses and governments make certain decisions. Finance plays a role in many of the stories in the news every day. This means that those who understand finance have a better grasp of how they are affected by the events of the world. Personal finances. Each person will also have to manage his or her own personal finances. Like corporations, individuals are faced with investment and financing decisions. In order to invest, individuals must be able to do the same projections and valuations as companies in order to determine the best investment for their needs. Individuals cannot sell equity like corporations, but they can choose to dip into their savings or take out loans. Many take on debt in the form of student loans, mortgages, or through their credit cards. Being able to properly compare options to leverage is just as important for individuals as it is for companies. Application to business. Of course, finance is an important field of study for those who have a desire to work in finance or accounting. Finance is heavily used in jobs ranging from investment banker to CFO to venture capitalist. However, finance is not segmented from the other functions in business. Nearly every job has to be able to manage a budget and make a business case that it should get funding for a project. This is especially true higher up in the organizational hierarchy. Managers, directors, and vice presidents need to be able to articulate why their departments should get financial support from the company. Finance is a field of both hard analytical skill and personal judgment. There are set processes and theories for determining which financial option is best, but in the real world, it is rare to have all of the information needed to be absolutely certain about what to do. Finance develops strong analytical skills, but also the degree of finesse required to operate in an environment of uncertainty. Describe the function of finance in various management roles within an organization. Defining corporate finance. The primary role of corporate finance is to determine how best to maximize shareholder value. Key points. Maximizing shareholder value can be done over the long term or the short term, so the job of the finance department is to determine how best to do both. Sometimes the goals may appear to contradict each other. The finance department is devoted to the task of figuring out how to allocate assets for the overarching goal of maximizing shareholder value. They must ensure that the right assets are in the right place at the right time. The finance department must also manage the company's liabilities so that all projects are financed in an optimal way without taking on too much risk. Key terms: shareholder, one who owns shares of stock; asset, something or someone of any value, any portion of one's property or effects so considered; liability, an obligation, debt, or responsibility owed to someone. Corporate finance. Corporate finance is the area of finance dealing with monetary decisions that business enterprises make. When finance is talked about in the context of business decisions, it is called corporate finance. Technically, corporate finance deals only with corporations, while managerial finance deals with all types of companies, but we will use the terms interchangeably. There are other branches of finance, such as personal finance, individuals taking care of their money, and public finance, the finances of the government. The primary goal of corporate finance is to maximize shareholder value. Maximizing shareholder value can be done over the long term or the short term, so the job of the finance department is to determine how best to do both. Sometimes the goals may appear to be in competition with one another. For example, a company can choose to pay dividends, a small payment to each person who owns a stock of a company, which increases short-term shareholder wealth. However, paying dividends means that the money is not being invested in long-term investments, which may cause the stock price to increase more in the future, and thereby increasing long-term shareholder wealth. The technique behind maximizing shareholder value is the management of assets. This means that the finance department figures out how to best invest its money. For example, a company could have two proposals from the R&D department to develop different products, but only enough money to fund one. The finance department will project out the future revenues and costs of each product and figure out which one, if either, is worth the money. Also, the finance department will determine when a company should take on a liability. For example, suppose both projects are sure winners, but the company still only has enough money to fund one. The finance department will figure out if the company should borrow money so that it can fund both. The role of finance in an organization is to make sure that money is at the right place at the right time. A company wants to have enough money to pay its bills, but also wants to invest so that it can grow in the future. The finance department is devoted to the task of figuring out how to allocate assets to do so, for the overarching goal of maximizing shareholder value. Financial managers ensure the financial health of an organization through investment activities and long-term financing strategies. Key points: financial managers perform data analysis and advise senior managers on profit maximizing ideas. The role of the financial manager, particularly in business, is changing in response to technological advances that have significantly reduced the amount of time it takes to produce financial reports. Types of financial managers include controllers, treasurers, credit managers, cash managers, risk managers, and insurance managers. Key terms: net present value, the present value of a project or an investment decision determined by summing the discounted incoming and outgoing future cash flows resulting from the decision. Overview: Financial managers perform data analysis and advise senior managers on profit maximizing ideas. Financial managers are responsible for the financial health of an organization. They produce financial reports, direct investment activities, and develop strategies and plans for the long-term financial goals of their organization. Financial managers may do any of the following: prepare financial statements, business activity reports, and forecasts, monitor financial details to ensure that legal requirements are met, supervise employees who do financial reporting and budgeting, review company financial reports, and seek ways to reduce costs, analyze market trends to find opportunities for expansion or for acquiring other companies, help management make financial and investment decisions. The role of the financial manager, particularly in business, is changing in response to technological advances that have significantly reduced the amount of time it takes to produce financial reports. In the past, a financial manager's main responsibility was to monitor a company's finances. Now, financial managers may perform more data analysis or advise senior managers about how to maximize profits. They often work on teams, acting as business advisors to top executives. Financial statements. Review this example of a financial statement that a financial manager would be responsible to prepare and interpret. Financial managers also perform tasks that are specific to their organization or industry. For example, government financial managers must be experts on government appropriations and budgeting processes, and healthcare financial managers must know about issues in healthcare finance. Moreover, financial managers must be aware of special tax laws and regulations that affect their industry. Capital investment decisions. Capital investment decisions are long-term corporate finance decisions relating to fixed assets and capital structure. Decisions are based on several interrelated criteria. Corporate management seeks to maximize the value of the firm by investing in projects which yield a positive net present value when valued using an appropriate discount rate in consideration of risk. These projects must also be financed appropriately. If no such opportunities exist, maximizing shareholder value dictates that management must return excess cash to shareholders, distribution via dividends. Capital investment decisions thus comprise an investment decision, a financing decision, and a dividend decision. Management must allocate limited resources between competing opportunities, projects, in a process known as capital budgeting. Making this investment decision requires estimating the value of each opportunity or project, which is a function of the size, timing, and predictability of future cash flows. Any corporate investment must be financed appropriately to achieve the goals of corporate finance. The sources of financing are, generically, capital self-generated by the firm and capital from external funders, obtained by issuing new debt or equity. Types of financial managers. There are distinct types of financial managers, each focusing on a particular area of management. Controllers direct the preparation of financial reports that summarize and forecast the organization's financial position. These may include income statements, balance sheets, and analyses of future earnings or expenses. Controllers are also in charge of preparing special reports required by governmental agencies that regulate businesses. Often, controllers oversee the accounting, audit, and budget departments. Treasurers and finance officers direct their organization's budgets to meet its financial goals and oversee the investment of funds. They carry out strategies to raise capital and also develop financial plans for mergers and acquisitions. Credit managers oversee the firm's credit business. They set credit rating criteria, determine credit ceilings, and monitor the collections of past due accounts. Cash managers monitor and control the flow of cash that comes in and goes out of the company to meet the company's business and investment needs. Risk managers control financial risk by using hedging and other strategies to limit or offset the probability of a financial loss or a company's exposure to financial uncertainty. Insurance managers decide how best to limit a company's losses by obtaining insurance against risks such as the need to make disability payments for an employee who gets hurt on the job or costs imposed by a lawsuit against the company. Important skills for financial managers: Analytical skills. Financial managers increasingly assist executives in making decisions that affect the organization, a task for which they need analytical ability. Communication. Excellent communication skills are essential because financial managers must explain and justify complex financial transactions. Attention to detail. In preparing and analyzing reports such as balance sheets and income statements, financial managers must pay attention to detail. Math skills. Financial managers must be skilled in math, including algebra. An understanding of international finance and complex financial documents also is important. Organizational skills. Financial managers deal with a range of information and documents. They must stay organized to do their jobs effectively. Describe the function of finance in various business scenarios. Corporate finance utilizes tools and analysis to help companies make sound financial business decisions and adequately manage their assets and operations. Key points. The finance group is in charge of budgeting. It will look for the optimal allocation of assets across all business functions. Corporate finance decides how best to finance projects. The department can either use existing internal funds, borrow money, or sell equity. The finance group must balance both short and long-term company goals, though the overarching goal is to maximize shareholder value. Distinguish finance from accounting. Key terms. Finance. To provide or obtain funding for a transaction or undertaking. To back, to support. Investment. A placement of capital in expectation of deriving income or profit from its use. Corporate finance deals with monetary decisions that business enterprises make and the tools and analysis utilized to make the decisions. Corporate finance is concerned primarily with making investment and financing decisions. That is, making sure that money is being used in the best way. The corporate finance department of a company is in charge of budgeting. Management must allocate limited resources between competing opportunities. Since a dollar cannot be used for more than one project at once, it is a challenge to determine how much money should be allocated to each part of the business. In determining how to allocate money, the finance group must also figure out where the money will be best utilized. This requires valuing projects and business functions. A large element of finance is deciding how exactly to value a project. There are a number of variables: inflation, expected revenues, expected costs, length of time required, that are all incorporated into the valuation process. Finding the true value of a project is often fraught with uncertainty, but without an accurate valuation, a company may allocate its resources suboptimally. The corporate finance department must also determine how to finance projects. A company can finance a project by using either internal funds, money the company already has, borrowing, or selling equity. Each option carries a certain cost that can be quantified. It is the job of the finance department to make sure that the overall cost isn't too high and that the company has an optimal mix of all three strategies. One public job function of corporate finance is determining whether the company pays a dividend, and if so, how much. The company has a responsibility to maximize shareholder value, but that can be achieved in multiple ways. Paying a dividend puts cash directly in the hands of shareholders, increasing shareholder value. However, paying a dividend means that money is not being reinvested in the company. If a company doesn't pay a dividend, and instead chooses to reinvest the money, the value of the company will presumably increase, in turn increasing shareholder value. The finance department determines which option maximizes shareholder value. Lastly, the finance department must also ensure that there is a good balance between long and short-term goals. The company must have enough assets to cover short-term costs, referred to as working capital management, and enough invested to ensure the company has long-term growth. Identify underlying financial principles that affect business decisions. Defining ethics. Ethics are the set of moral principles that guide a person's behavior. Key points. Ethical behavior is based on written and unwritten codes of principles and values held in society. Ethics reflect beliefs about what is right, what is wrong, what is just, what is unjust, what is good, and what is bad in terms of human behavior. Ethical principles and values serve as a guide to behavior on a personal level, within professions, and at the organizational level. Key terms: behavior, the way a living creature acts; ethics, the study of principles relating to right and wrong conduct; values, a collection of guiding principles, what one deems to be correct, important, and desirable in life, especially regarding personal conduct; business ethics, the branch of ethics that examines questions of moral right and wrong arising in the context of business practice or theory. Ethics are the set of moral principles that guide a person's behavior. These morals are shaped by social norms, cultural practices, and religious influences. Ethics reflect beliefs about what is right, what is wrong, what is just, what is unjust, what is good, and what is bad in terms of human behavior. They serve as a compass to direct how people should behave toward each other, understand and fulfill their obligations to society, and live their lives. While ethical beliefs are held by individuals, they can also be reflected in the values, practices, and policies that shape the choices made by decision makers on behalf of their organizations. The phrases business ethics and corporate ethics are often used to describe the application of ethical values to business activities. Ethics applies to all aspects of conduct and is relevant to the actions of individuals, groups, and organizations. In addition to individual ethics and corporate ethics, there are professional ethics. Professionals such as managers, lawyers, and accountants are individuals who exercise specialized knowledge and skills when providing services to customers or to the public. By virtue of their profession, they have obligations to those they serve. For example, lawyers must hold client conversations confidential, and accountants must display the highest levels of honesty and integrity in their record keeping and financial analysis. Professional organizations such as the American Medical Association and licensing authorities such as state governments set and enforce ethical standards. Examples: the concept of corporate social responsibility emphasizes ethical behavior in that it requires organizations to understand, identify, and eliminate unethical economic, environmental, and social behaviors. Employees can more easily make ethical decisions that promote a company's values when their personal values match the company's norms. Key points: personal values provide an internal reference for what is good, beneficial, important, useful, beautiful, desirable, and constructive. Personal values take on greater meaning in adulthood as they are meant to influence how we carry out our responsibilities to others. To make ethical and moral choices, one needs to have a clear understanding of one's personal values. Key terms: value, a standard by which an individual determines what is good or desirable, a measure of relative worth or importance. Norms. According to sociologists, social norms are the laws that govern society's behaviors. Personal values provide an internal reference for what is good, beneficial, important, useful, beautiful, desirable, and constructive. Over time, the public expression of personal values has laid the foundations of law, custom, and tradition. Personal values in this way exist in relation to cultural values, either in agreement with or divergent from prevailing norms. Personal values are developed in many different ways. The most important influence on our values comes from the families we grow up with. The family is responsible for teaching children what is right and wrong long before there are other influences. It is thus said that a child is a reflection of his or her parents. Teachers and classmates help shape the values of children during the school years. Religion, or a lack thereof, also plays a role in teaching children values. Personal values take on greater meaning in adulthood as they are meant to influence how we carry out our responsibilities to others. This is true in the workplace, especially for managers and leaders who are charged with overseeing resources for the benefit of others. Because of their authority structures, social norms, and cultures, organizations can have a powerful influence on their employees. Employers do their best to hire individuals who match well with the organization's norms and values. In this way, they seek to promote their standards of ethical behavior. Conversely, Conflicts can occur between an individual's moral values and what she perceives to be those of others in their organization. Since moral judgments are based on the analysis of the consequences of behavior, they involve interpretations and assessments. One might be asked to do something that violates a personal belief but is considered appropriate by others. To make ethical and moral choices, one needs to have a clear understanding of one's personal values. Without that awareness, it can be difficult to justify a decision on ethical or moral grounds in a way that others would find persuasive. Example: if you value equal rights for all, and you go to work for an organization that treats its managers much better than it does its workers, you may form the attitude that the company is an unfair place to work. Consequently, you may not produce well or may even leave the company. It is likely that if the company had a more egalitarian policy, your attitude and behaviors would have been more positive. Investment and financing decisions boil down to how to spend money and how to borrow money. Key points: the primary goal of both investment and financing decisions is to maximize shareholder value. Investment decisions revolve around how to best allocate capital to maximize their value. Financing decisions revolve around how to pay for investments and expenses. Companies can use existing capital, borrow, or sell equity. Key terms: expected return. Considering the magnitude and likelihood of exogenous events, the average yield that an investor predicts will be earned. Financing: a transaction that provides funds for a business. Equity: ownership, especially in terms of net monetary value of a business. There are two fundamental types of financial decisions that the finance team needs to make in a business: investment and financing. The two decisions are essentially how to spend money and how to borrow money. Recall that the overall goal of financial decisions is to maximize shareholder value, so every decision must be put in that context. Investment: an investment decision revolves around spending capital on assets that will yield the highest return for the company over a desired time period. In other words, the decision is about what to buy so that the company will gain the most value. To do so, the company needs to find a balance between its short-term and long-term goals. In the very short term, a company needs money to pay its bills, but keeping all of its cash means that it isn't investing in things that will help it grow in the future. On the other end of the spectrum is a purely long-term view. A company that invests all of its money will maximize its long-term growth prospects, but if it doesn't hold enough cash, it can't pay its bills and will go out of business soon. Companies thus need to find the right mix between long-term and short-term investment. The investment decision also concerns what specific investments to make. Since there is no guarantee of a return for most investments, the finance department must determine an expected return. This return is not guaranteed, but is the average return on an investment if it were to be made many times. The investments must meet three main criteria. It must maximize the value of the firm. After considering the amount of risk the company is comfortable with, risk aversion. It must be financed appropriately. We will talk more about this shortly. If there is no investment opportunity that fills, 1, and 2, the cash must be returned to shareholder in order to maximize shareholder value. Financing. All functions of a company need to be paid for one way or another. It is up to the finance department to figure out how to pay for them through the process of financing. There are two ways to finance an investment: using a company's own money or by raising money from external funders. Each has its advantages and disadvantages. There are two ways to raise money from external funders: by taking on debt or selling equity. Taking on debt is the same as taking on a loan. The loan has to be paid back with interest, which is the cost of borrowing. Selling equity is essentially selling part of your company. When a company goes public, for example, they decide to sell their company to the public instead of to private investors. Going public entails selling stocks which represent owning a small part of the company. The company is selling itself to the public in return for money. Every investment can be financed through company money or from external funders. It is the financing decision process that determines the optimal way to finance the investment.